We are live. Welcome, Portfolio Builder members, to the Thursday update. We just had a bad CPI report and the markets are skyrocketing up. Let's try to make sense of this. Our portfolios are doing extremely well because we've been bullish, expecting essentially a ramp up in markets till about April. High risk portfolio is now up 4.15% for October. The high risk portfolio last year returned a grand total of 233%. And our safe growth portfolio this year in October is up an outstanding 18%. A lot of that gain is coming from NRGU betting on oil. This is a very good explanation of what markets are thinking right now. Contrarian take. The CPI report was not as bad as initial reactions suggest. All items ex food and shelter were only up 0.1% in September. As the charts below show, food inflation will fall and rents on new listings have already rolled over. Wage growth also looks set to cool. So the CPI is essentially looking way into the past while markets are trying to figure out what's going to happen 3 to 6 months into the future. So what we're essentially thinking here is inflation is going to be sticky, but top out and then start to fall here. And we think it's actually going to fall very aggressively. So the risk now is over tightening because I think the Fed has already done the job to get the inflation to stop and roll over. This is looking at the rate of change of rents falling quite rapidly. In this chart, we can see wage growth versus job openings. Job openings are crashing, and that means most likely wage growth is going to start to slow down aggressively. It's not going to be as easy to swap jobs and get a raise anymore. Furthermore, if we look at the CPI versus ISM manufacturing prices paid, ISM manufacturing prices paid have been crashing all year, and now we're starting to see CPI catch up. Another input, just a dramatic crash now that the COVID madness is being ripped to shreds. Now this whole health insurance cost is crashing as well. Also, we've got a very inverted yield curve. This is typically when we're going to hit peak interest rates. You want to bet big on tech or crypto. I think we're about to enter a massive cryptocurrency bull run. Here's another way to look at it. We're looking at the 70s when we had this type of inflation. And I want you to look at the blue line, that's your stock market, and then the US CPI in the orange or red color, whatever that is. It peaked out, and that's when the bottom of the stock market crash was in 1974, led to a massive run up. And again, we're expecting essentially sticky inflation for about 6 months, and then highly deflationary forces coming in. So that's what we're likely seeing in markets right now. Let's take a look at how we're recommending to, Don wants to be a day trader. No, hold on, buddy. We're about to go to war and oil's about to go skyrocketing. Okay, so let's take a look at the current recommendation for high risk portfolio. To get the safe growth, you have to be a paid member. I'll be revealing that at the end, but that's only for paid folks. So let's take a look. This is what's inside the membership area. And if you type in whatever amount of money you want to invest, it'll automatically calculate your shares. We all follow a unit of investment. So all our members get the exact same returns over any period of time. So right now, one unit is coming in at $2,165, and it's comprised of 19 shares of the Crash Insurance, ticker UVXY, 36 shares of the 3 times levered treasuries. So we're betting on interest rates going down, TMF. We have 14 shares of EUO. That's a leveraged bet that the dollar will gain in value against the euro. Perhaps the real reason why markets rallied today was ECB came out with a target rate for Europe that was extremely low relative to inflation. So the market saw that as very bullish. This could make the dollar rise rapidly against the euro until the Fed finally pivots. And I think we're probably going to be a few months out before that. So we could be holding on to EUO a bit longer until we get some more dramatic data in that would actually create that Fed pivot we're looking for. But we got the ECB having to pivot first, which is good for markets. Okay, next on the offensive side, we have 57 shares of our favorite growth asset, ETHE. That's the Grayscale Trust for Ethereum. Lets you buy it in your stock brokerage account. Next, we have 27 shares of FNGU. This is 12 monopolistic tech giants, 2 out of China, 10 in the US. These tend to get the most call option buying and outperform their peers in bull markets. Now, in bear markets, they can sometimes underperform. So FNGU and ETHE are at extremely low prices relative to their peaks, and so are treasuries. So if you're looking for value, we are a big fan of loading up on treasuries, Ethereum, and tech stocks. In the short term, though, we have catalysts to take oil sky high, and it could be a headwind against tech and rates. And that's because of a number of factors that are affecting energy markets that are not good. I'm expecting NRGU to explode higher here, potentially in the next few months, and then we'll take some profits off the table. Now, if you're watching this on YouTube on replay, you're not going to get the trade alerts. You need to call Dean now to upgrade and gain access to the membership area, plus the second strategy we're not covering here today, which is a highly diversified, safe growth portfolio, where we recommend 70% of your assets be held and only 30% in our high risk strategy. Call Dean now to upgrade at 505-322-7515. Okay, let's break down each part of the trade alert one by one. I've reordered it to put the most interesting stuff first, where I think you're gonna make the most money in the least time. And then the other parts of the portfolio that are just super critical to protecting your overall strategy and reduce your volatility, we've pushed those last. So right now, the most interesting opportunity to make a lot of money in the least time frame is going to be with this war that is escalating. So we like NRGU. Mary says, why does oil go up when inventory was more than forecast? So, well, we'll take a look, but essentially I've got a whole bunch of slides on it for the bullish case. Let's just take a look at that. First of all, what's going on? Why are we at war? And so the rich dad, poor dad fellow says this, are you ready for World War III? And again, I'm not sure I completely line up with his trade alert advice, but I do like his historical view on things. History shows wars are all about energy, oil, and coal. Hitler invaded countries like Romania for their oil and coal. Japan attacked Pearl Harbor when the US cut Japan from oil. Was the sabotage of Nord Stream pipeline to start World War III? And so here's some of the reasons why we have an energy crisis right now. Day one, we killed the Keystone, which would have supplied about 800 million barrels a day. We dumped the SPR, and so now they're talking about extending that, but it's going to very dangerous levels here. This was all to try to get gas down for midterms. We've basically blocked all leases to expand oil, and then we've gone and sanctioned Russia. So this is just all added to a disaster here. Here's the days left in the Strategic Petroleum Reserve. So they've been dumping it really rapidly. They're, at the current pace, there's only 22 days left. So the market's realizing as soon as this stops, we got a big problem. Now, what if the US needs to refill the Strategic Petroleum Reserve? Of course, that's going to be a huge problem here. And so here you can see the reserves being dumped. U.S. Deputy Energy Secretary says the U.S. still has the ability to use SPR over the coming weeks and months as needed to fight high petroleum prices. Live Monitor says no, it doesn't. It has 325 million barrels left, with about 150 million of that unusable. Furthermore, there's a critical level that you simply cannot use in case of a real emergency, like a Colonial Pipeline style attack. Now, there's some seasonality in our favor right now. And this is looking at the S&P 500 performance from November through April in midterm to pre-election years, and 100% win rate in terms of gains. Now, again, we got a lot of these years in the 70s and 60s where we had high levels of inflation. So we'll see if this plays out. Now, not looking at midterms at all, the trend is essentially a melt up from October into December, just overall seasonality. Now, this is Chinese state affiliated media, but I think they nailed it on the head. What is the US really up to? Do we really care about Ukraine's democracy, or is there some other grand scheme at play? Russia's cheap energy and China's big market support Europe's prosperity, specifically Germany. The US pushes Europe to decouple from Russia and China, aiming at killing three birds with one stone, weakening China, who we don't want to expand their 5G network via Huawei. Russia, they like to completely change the regime and take over all their resources, and then weaken EU, keep them in the power of the US. And so far, it's working out quite well. Another potential bullish catalyst ahead for oil will be soon as inflation's starting to fall and interest rates are falling and the Fed's pivoting, I expect China will then pivot against this zero COVID policy. They still keep locking down everything, but they have now extended the expectation to do this. So the second that flips and they want to get their economy back rolling, the demand for energy out of China is going to skyrocket. Here's a look at Russia's key commodities and what this war, as far as a regime change in Russia, is all about. They have massive amounts of critical commodities. And you can see their share of various productions. So it's very, very rich territory there. Now, where will Russia actually stop? Are they going to give up at Ukraine? Or are they going to expand? An expert in this space is a guy named Peter Zahan. He has a NATO globalist, democratic type of bias, but I do pay attention. And here's where he believes ultimately Russia wants to expand. So this could be quite some time that we're dealing with Russia if they're not crushed. So we'll see how this plays out. Now here is NRGU. It is volatile as all hell, but the catalyst with war and with China reopening and the SPR coming to an end, plus OPEC now deciding to partner with Russia to keep these prices high, tells me as long as the Fed doesn't over tighten and crash the global system, that NRGU could go dramatically higher. So I will start shedding this at the 550 level and probably be completely out if we breach 600, because that does take us to all-time high valuations. In the Big 10 US-based oil and gas companies who are partnered up with the globalists. And here are those big names that get to have a monopoly on oil with these sky-high prices. And we can, again, get 3 times leverage. Also, Warren Buffett, big investor, I think he owns about half of Occidental. And that's how he's protecting his Apple position. So oil here bouncing off that 80 level. And we'll see if they try to put price caps on Russian oil, Russia's going to stop supplying the oil, and it's going to drive oil to new highs most likely. So we'll see if they do this or not. But the talk is that they want to do that, and this would be devastating to the global economy. Here's Exxon. Again, we're already trading at high valuations. The catalyst to go higher is there. We would want to sell into a rip up in oil. And there's that chart once again. Okay, so that is the inflation hedge, the war hedge. It's a critical part of all of our portfolios. And we're going to have to hold it through winter. At the earliest, I see us selling this around February, March. But we'll see. If oil goes back to new highs, we'll be dumping and with a very big smile on our face. Okay, next play. So that's, again, a 3 to 6 month opportunity I see to make a lot of money. Over the next 2 years, I think it'd be very hard to make more money than investing in Ethereum. If we're right, interest rates are peaking out and the inflation's topping off, we're likely entering about a 2-year period of interest rates falling. And if interest rates are falling, but the economy is still healthy, there's no asset, I believe, that'll make more money than Ethereum or the products being developed on Ethereum. So we need to think of Ethereum as more than Bitcoin. It's actually an operating system. So if you think about what made Bill Gates so rich, creating Windows, that's what Ethereum is. We believe you can make even more money investing in the early stage applications that are going to make Ethereum successful. Those are not available in the stock market, but if you are a paid member, call Dean about Rebel dividends, and you can get better returns than just betting on Ethereum. So let's look at the case for Ethereum over the next 2 years. It's just a funny little cartoon. They're mad at Bitcoin for using something like 0.2% of the energy in the world, while they create hyperinflation through printing trillions of dollars at rapid pace globally. Now, Bitcoin tends to bottom right before the NASDAQ bottoms, right before the S&P 500 bottoms, in that order. And the reason why is there's smaller market caps in Bitcoin than a smaller market cap in the NASDAQ, and then the S&P 500 is the biggest. So the momentum is easier to stop for Bitcoin than these larger market caps. And in this chart, we're comparing the United Kingdom's debt market to Forex Bitcoin. And you can see the United Kingdom's debt market has crashed harder than Bitcoin. Just something to see there. Willie Woo says Bitcoin took 6 months to get 1,000 users, 5 years to find 1 million users. Today, 13.8 years from inception, it has 300 million users. That's 4% of the world. At current growth rates, 1 billion users would be hit in the next 3 years. That's 12% of the world. Adoption curves, looking at world population. Then you can see the growth of the internet. And then you can see Bitcoin is just barely getting started. So you're not too late to jump into that. Now, as far as the US government freaking out and starting to do things to prop up assets, a day ago or 2 days ago, Yellen was being interviewed and she said, "I see nothing wrong with markets," which is crazy talk because we have the worst crash in the 60-40 stock bond portfolio since the Great Depression in 1931. US Treasury Secretary a day later says, "I'm concerned about the loss of adequate liquidity in treasuries." This is a look at who's adopting blockchain technology, not necessarily Bitcoin or Ethereum, but everybody is in on it. The writing's on the wall. We got everybody from Intel, Oracle, AMD, Facebook, Verizon, Google, Tencent, Adobe, Qualcomm, NVIDIA, working your way to the big banks, JP Morgan, Bank of America, you name it. Breaking a new all-time high, 62% of Bitcoin has not moved in over 1 year. Name another asset where holders refuse to sell after a 72% drawdown. Okay, so here's the real case for why you want to be loading up big time on cryptocurrencies. Hedge it with oil. That's what is really the only thing holding us back here, is these energy costs reviving. But here's the big argument for why we're about to see an absolute melt up in cryptocurrencies. So let's go back to 2015 and 16, which led to this epic run up from 800 to almost 20,000 on Bitcoin in about 16 months. And what led to that? So just like now, we have a collapsing Chinese economy in 2015 and 16, which was driven by interest rates rising, also what we've been facing right here. And it led to driving a scare in foreign currencies to buy the dollar. And we pushed the DXY index to 103 by the start of 217 from these rising interest rates. Now, here's the catch. Today, we're at 114. So the move, the amount of money that could potentially be moving is monumentally larger in this setup compared to the previous. But here's what happened. Once this collapse in Chinese real estate was contained and interest rates stopped rising, the DXY index fell from 103 to 92.5, or a 10% decline. And here's that drop. So DXY went from 103 to 92. And as this occurred, Bitcoin skyrocketed 464%, sending the price from 800 to 4,337. Took 8 months to pull this off. Here's that move. It just went parabolically to the upside. This is exactly the type of move we believe we're on the verge of here. Today, we have all of Asia and Europe selling US treasuries and stocks to gain dollars, which they're then in turn using to buy their own currency. The hope is to prevent a further collapse in their currencies against the dollar. But the irony is this is accelerating the problem and has driven the DXY index even higher to 114. And you can see it's going up faster and faster. There's only one thing that will solve this, and that's going to be inflation topping out and the Fed pivoting here. We are expecting interventions to be necessary very soon by the US to reverse this trend in order to protect its stock and bond markets from collapsing further than they already have, especially treasuries, which is critical to the government and the Fed. This coming pivot is likely near and could lead to an explosive move higher in cryptocurrencies. Now, this chart perfectly lines up with the bull markets in treasuries. And so if we are correct that interest rates have topped out, inflation's topping out and in the process of reversing, then the bull market's essentially at our doorstep. And it should last, based on trends, about 2 years. Now, on the bond market front, back in 2016, the US bond market, if we use the TLT ETF to measure the change, had cratered from 145 to 120, a 17% move. Okay, today, guys, we're at 100. Okay, it's just mind-boggling to see such a crash in the safe haven asset of the world. Once the problem again had been contained and the bond market stopped crashing, the DXY index fell with interest rates, and what resulted was an epic rally in cryptocurrency. So here's your TLT crashing, just like we've had today. And then the second it started to bottom out and rise, we get this massive melt up. So this is now looking at a 16-month time frame instead of the 8. But Bitcoin front run the move. So before the bond market had finished crashing, Bitcoin predicted the bottom, traded flat at 800, and then skyrocketed to $19,000 or a 2,423% return in 16 months. So look at 2016 leading up to 2017. That's when bonds were still crashing. Bitcoin didn't care. As soon as the crash was over and rates started to fall, TLT's going up, you get this parabolic move. And the momentum just builds and builds and builds for crypto until you get these just asinine moves straight up. Today, we sit on the longest and deepest crash in the US bond market history, resulting in a 40% decline in the TLT and 114 level on DXY. The chance of this being allowed to continue for much longer is low because it puts the US stock and bond market at high risk of further deterioration at a time when the US needs to raise $1 trillion to cover its expected annual deficit. There's that TLT crash. Again, this is historical, an anomaly in history. If it's falling, it will almost certainly spark a massive short squeeze in large players who are short equities, bonds, and foreign currencies, and lead to a massive rally in stocks, bonds, and cryptocurrency. In fact, it looks like that actually started today. That's why we saw this ridiculous move up on bad CPI data. Okay, Druckenmiller says if cryptocurrencies could have a renaissance if people lose trust in central banks. And we're starting to see this in every bank because they're having to buy their own debt. You know, when we've reached a unique time in history when Bitcoin suddenly is less volatile than fiat currencies. And these cryptocurrencies have a limited supply while fiat currencies have unlimited. Some more looks at various technologies as they are adopted. And again, all we really need to worry about, will governments run deficits? In other words, spend more money than they make? If so, over time, this asset's going to go up in value. Because what ends up happening is they end up having to buy their own debt. Some technical indicators, 200-week moving average, been hit 4 times in history, led to massive bull markets. 2015 and 16, it double bottomed, which is essentially what we came across this morning with it hitting 18,000. RSI is only signaled to buy 3 times in history. We had the worst month ever, worst quarter ever. And now Ethereum has a higher dividend than the energy sector, the highest dividend sector in the stock market. But energy stocks are priced at all-time highs. Ethereum fell from 4,000 to 1,200. So it's at a screaming discount. So you can make 10 times your money potentially on Ethereum and get a 5% yield. So what are you going to bet your money on long term? Here's the look at global debt, $250 trillion. And there's no change in the trend. US federal budget deficits expected to grow from $1 trillion to 2.3. That's assuming no recession and current interest rates. If we have to refinance 32 trillion in debt from 2% up to 4%, all of a sudden the debt payments go from 700 billion a year to 1.4 trillion. And it grows from 15% of GDP to 30% of GDP. But what if GDP contracts? All of a sudden, this is going to take up 30, 40, 50% of our entire budget. This is unfathomable and why it won't be allowed to happen. Here's the hyper exponential growth of debt. What took 215 years was doubled down in 2. Okay, let's look at the charts. Ethereum to date down 59% by that dip. You can see it's been bottoming out since July. Here's the all-time chart on Ethereum, up 9,000%, even if you held through every crash it's been through. ETHEs are play. It's down more than the real asset. Another reason to look at Rebel Dividends instead of the Grayscale Trust, down 68%. So again, if you're a paid member, instead of owning ETHE or GBTC, you can invest in Rebel Dividends, and we're going to give you leverage plus a weekly dividend. And rather than just owning Ethereum, we're going to buy all the applications being developed on Ethereum. Just before we had this big crash starting in last December, some of the tokens we're investing in outperformed Ethereum 10 to 1. So give Dean a call to learn more about Rebel Dividends, only for paid members, 505-322-7515. All right, let's look at the crash insurance. UVXY has been somewhat of a dud. It's up 30% in the last month, but it's not making a huge gain. This is looking at a soft versus hard landing. So some potential levels from Goldman Sachs. But if we look at this is the 60-40 portfolio. The only time we've had a return this negative was in the Great Depression, 1931. But look at the years coming off of that, 33, 34, 35, 36. You had double-digit returns 3 out of 4 years. 32 was flat, but I'm expecting essentially money to flood back into both treasuries and stocks because they're both at a steep discount relative to recent highs. Some signals to buy percent of stocks above the 200-day moving average. Less than 10% is a screaming buy in the 2009 crash, in the dot-com bubble, although it falsely signaled to buy it a year early, to be fair. 2018-19, also good signals. So we've had about a 25% decline in the S&P 500 over 10 months, and that's why the UVXY has been a dud. The time it went up a lot, the SPY fell 25% in a month, and UVXY went up 1,000%. We're up over 10% of our portfolio in UVXY. So if I'm wrong and an absolute epic market crash is about to crater markets, we're completely protected, have nothing to worry about. That's not my base case. Here's UVXY up 27% in the past month, flat over the last 3 months. Now, one cause for concern is if the dollar's allowed to stay at this level and interest rates are allowed to stay at this level for too long, it'll almost certainly crush Asia and Europe first, and then the contagion would spread to the US. So we're watching Asia and Europe to see if there's any deviation in drawdown relative to the US. So far, it hasn't been the case. Okay, next section, bonds. Buy 36 shares of TMF, the deflation hedge. Okay, so here's the CPI. So note, energy led the inflation. Okay, now that energy inflation has worked its way into essentially services, goods, and foods. But now note, energy has gone negative. I believe we will soon see services, goods, and foods also contract. So essentially, we're now expecting 3 to 6 months of sticky inflation at around these levels, probably cooling off, and then it falls quickly. Again, rent, huge part of the CPI falling, but this won't show into the data for about 6 months. Now, let's take a look at all the times central banks have tried to reduce their balance sheets. As you can see, very, very infrequently do they do this. And when they do it, it does not last long because it wreaks havoc on governments globally that want to spend more money than they make. So unless governments want to stop spending more money than they make, this will not last for long. Here's a breakdown of that consumer price index. So shelter, 32%. It's already falling. It's going to start picking up in the CPI in about 6 months. Food, already falling. Again, it's going to take some time to show up in it. Energy is already falling. Medical services are crashing. So we're highly confident inflation is going to start to fall. Zero Hedge says, here's the kicker. CPI says shelter index rose 6% year over year, accounting for over 40% of the total increase in all items, ex food and energy. This is because the rent data is 6 to 9 months delayed from the market. Now, Bank of America is predicting payrolls will slow down to December and then go negative and be negative all of next year. That's where your pivot could officially start to occur. So we're very, very close. This is looking at the hiring plans momentum compared to payrolls. And this is predicting essentially the same thing as this chart, that we're about to have zero labor growth by December, and then it's going to go negative into next year. Bloomberg says fragile liquidity in bond market could threaten the quantitative tightening plans. Live Monitor believes that won't actually happen, or it'll be limited compared to what they're saying. Right now, they're saying they're going to sell $3 trillion in bonds. Mortgage rates at this level are highly deflationary. No one's going to go buy super expensive houses because what they get now is about a third of what they got a year ago. Bond market's getting just demolished. Here's the UK one just crashing massively. Not only is this the most aggressive hiking cycle since '83, the Fed may also keep rates steady for longer. We're going to look at what they say they're going to do versus reality. And the truth is they always say they're going to do a lot more than they ever do. But should this do the trick? Absolutely. If they over tighten, we've got problems. So we'll see if they reverse course here or not. But you can see they've hiked interest rates at the fastest pace in history in the red line. This is just from a bakery. This is why our prices have gone up. So flour going from 12 bucks to 28, sugar from 25 to 34, shortening from 41 to 87. So we're not actually expecting these prices to go down. We just think they're going to stabilize, and that's all this we're predicting here. Now Germany's bond market's crashing. This is the opposite. So if it's going up, it means the market's crashing and it's just getting demolished. So ECB is going to have to start pivoting, print money, and do yield curve control across all of Europe here. PPI, the producer price index, already been falling for quite some time. It picked up a little bit this month, but the trend is down. This is the worst month in government bonds since 1721, when the South Sea Company bubble burst. The next time was the Civil War in the 1800s. And then the next few times were during World War I, World War II, or the lead up to World War II. Some other just funny charts in bond market. So if you're betting, so people like to buy these long duration bonds for leverage. And so Austria came out with this 100-year bond. And for 4 years, you doubled your money on the bond. So as yields fell, you made a ton of money betting on that. But then once the inflation upset everything and central banks started tightening, you can see it crashed from 240 to 71, probably the greatest crash in any major bond market's history. Another look at the rate of change of dividends. The only period that's probably more steep was when Volcker went parabolically to the upside. Not possible with the debt to GDP levels we're facing in the US. There's no way they're going to do something like that. Here's the UN food price index falling. So we're highly confident. Another way to predict CPI is look at household net worth. they've wiped out $14 trillion of net worth. And that's highly predictive of people slowing down spending because they're not as rich. US job openings per unemployed person falling. So there's really a lot of good data to believe we are at peak inflation. We'll start to top out and fall here. ISM prices paid versus CPI, again, another predictor. United Nations is calling for the Fed to stop. So there you go. Wages versus CPI starting to slow down as well on top. Houses going negative. And now we got a lot of people searching for food, for SNAP and unemployment benefits. Now, this is where we get the dots of what they said they're going to do versus what they really did. And so the expectations were much less, and they went way aggressively to the upside. Now the expectation is to hike this up to 4.5%. And there's just no way they're going to pull that off without crashing everything. This just shows you how unusual it is to crash stocks and bonds. Usually if one goes down, the other goes up. This is showing you when yield curves go inverted, you typically have peak interest rates and fall from there aggressively. It could top out for a little while, then fall. Sometimes it just falls right away. So here's the play for betting interest rates go down. By TMF, it's down 39% in 3 months. It's a leveraged version of the TLT. And this is just a screaming bargain. We can get crashes in the bond market, but what happens right after that? It rallies up. This is how the governments grow debt. Some other bond markets, LQD is now at the 2008 level. Very bad. Corporate debt on the high yield space isn't as bad. Here's a look at some of these shorter term treasury products. So we got the 3 month gone straight up. What happens? It tops out, then it crashes down. 2 year, what happens? It tops out and then crashes down. Here's the 3 month. So this is what's predicting where the federal funds rate will end up. So this is saying 4.4, and we're nowhere near that level. There's the 10 year predicting long-term interest rate, inflation and interest rates. But the trend again is crash and grow debt. 30 year, same picture, just way, way, way above trend. This is setting up for an epic move to the downside. Italian bonds, same picture. So some of the input costs that are going to be the leading indicators are all crash. Lumber futures down 60%. Copper futures, while still elevated, down 22%. Baltic Dry Index cost to ship materials down 18%. Wheat futures are up. Okay, we're still seeing the inflation in food in some of those inputs. Overall, it's been falling. And there's that CPI likely topping out. Another indicator to buy stocks is when sentiment gets to extreme lows. That's usually when things are about to turn around. And we got that. Jobless claims picking back up. If this hits 300,000, that'd be very good for a pivot. Nowhere near that yet. Again, looking at inverted yield curves, typically when peak interest rates are there. Okay, the US dollar against the euro with EUO. Live Monitor says DXY to 120 incoming. Europe has no choice but to do yield curve control soon. EU pensions are on the verge of blowing up. They may not even make it to the next ECB meeting, and we got the news today. It's probably why I got that market melt up. They're putting their peak interest rate at something like 2.5%, which is really, really low. Ray Dalio says, I changed my mind. Cash is not trash. China signals massive dollar dump ahead to protect their currency. Here's the currencies against the dollar. British pound down 18%. Everything's down except for the ruble. Here's some other comparisons. Dollar index up 22%, Canadian dollar down 8, Australian dollar down 11, euros down 18, the pound's down 22, and the yen's down 23. Now this chart, we're looking at DXY. I want you to note, as the debt has grown in the US, the peak in the dollar has become lower and lower over time. So not only do I think the dollar could fall to 90, I think it could potentially fall much, much lower. If we get the dollar falling from 114 to levels we've seen in 2008 to 70, something like cryptocurrency could go absolutely insane to the upside. We'll be taking profits at 90 and not being greedy, but you can see the potential for a swing from the dot-com bubble went from 120 to 70 to 2008. And then we had a crisis and we started building the value of the dollar back up. Another look at the DXY again. Nice return on EUO this year. It could go higher. ECB is going to pivot first because their economy is in disaster due to the war, and there's no end in sight to the war. The euro down 16% against the dollar, the yen down 27% against the dollar, and the yuan from China down 12. The ruble actually up against the dollar 18%. All right, stocks. We like FNGU, tech giants. They're down a lot. One of them is Intel, this bigger crash in Intel than the great financial crisis because Biden come out and banned all chips going to China. Again, part of the war we were talking about is to prevent China's expansion in the technology sector. Weaken Germany, make them not reliant on Russia or China, collapse Europe, collapse Russia, take over their commodities, and slow down China's rise. That is the goal. So are we at the absolute bottom? Perhaps. China's starting to print money. Here's the chart. This also led to the boom in crypto. So 2015-16 led them to start printing money. They've been trying not to do this until the Fed pivots because it'll make their currency collapse and bond markets. But they're starting to have to, and we can see it's starting to pick up. Here's the growth rate of China, pretty much zero. That's a big problem. They're going to have to get things going here soon. Okay, let's look at the internals of the U.S. economy. Consumer spending keeps hitting new highs. Balance of trade is falling, but still, we're still buying more than we export. Shows we still have a healthy economy, but it's good to see it slowing down. That means less inflation. Retail sales keep growing. It's just absolutely ridiculous. Consumers keep borrowing more and more money as their savings are being drawn down. Banks keep increasing their loan base, and buybacks are going to hit a record high. Plus, no one's taking risks. There's trillions of dollars sitting in cash globally. Growth by decade for S&P 500 is tremendous. I do think there's a potential for emerging markets to outperform the U.S. in this next run up. Massive amounts of hedging happening, which could create an epic short squeeze. Okay, midterm years tend to bottom later in the year and see large corrections. Average return is 33% from the bottom. Assuming we hit the bottom, could be in for a really nice ride here. FNG went below $5 for a little bit there, but you can see its last peak was over 40. So this one could have a really nice return here over the next 2 years alongside crypto. S&P 500 is now down 22% on the year. The NASDAQ's down 29% on the year. Emerging markets down 29%. This chart shows you about every other cycle, emerging markets greatly outperforms US markets. And we have the setup for the dollar to fall, interest rates to fall. That's what you need for emerging markets to outperform. We need China to stop doing its zero COVID policy for their economy to pick back up. But again, I think they're waiting for the dollar to weaken to do that so they don't collapse their currency market. Europe only down 28%. So we're not worried yet about the crisis in Europe creating some sort of massive meltdown because they're down the same. In our safe growth strategy, we like uranium. Everybody's realizing we need nuclear power. Rare earth metals, another play out of China for lithium, important for the electric car industry and anything with batteries. Some individual stocks, Amazon's down 31%, Apple's down 18%, Alibaba's down 42%. So you can see there's some screaming deals out there. China's PMI is falling, but it's still in positive territory. China's exports are still strong. China's imports are still strong. So we're not seeing some sort of just economic collapse, just a slowdown, which is perfect for what we're looking for. All right, this is where your video ends. If you're not a paid member, I'm about to go into the membership area. And so you need to upgrade to see that footage and get the next trade alert. Call Dean now at 505-322-7515.